know this is a very cheerful topic, but unfortunately this is rampant nowadays. So maybe I'll start off by a quick show of hands. How many of you out there have heard of FATCA? Okay, quite a number of you. Okay, good. So FATCA, complete with its hundreds of pages of rules and regulations, has a singular purpose of basically hunting down US taxpayers worldwide. That's the goal of FATCA, and every country in the world has or is in the process of signing up an IGA with the IRS. So I think no matter what happens next Tuesday, I think FATCA and all those offshore reporting is going to be our IRS priority going forward, just because of the simple fact that they need the cash. So today I'm just going to go over at a very high level some of the common reporting forms that the IRS really cares about. So the first one we see a lot, and the reason that we see a lot of these is because whenever you have a Canadian company that holds at least 25% of a US company, you have to fill out this form. And this form started with the purpose of helping the IRS do stuff like transfer pricing. Because what they're going after is when you have a 25% foreign-owned US company, they want to make sure that the profits in the US company are not being sort of reduced artificially by charges from the Canadian parent. And you need to have one of these forms per a related party. So if you have a Canadian parent, but also have a Canadian brother corp, then both of those entities would have to be reported on the US company's form so that the transactions with each related party is on the form. And the things that would go on this form is basically all kinds of transactions that has an impact on the taxable income of the US company, such as management fees, rent, interest payments, and things like that. You're also supposed to disclose things or transactions that took place at less than fair market value. Again, that goes to the transfer pricing angle. And as of May of this year, the IRS has put up proposed regs that basically says not only do US companies that's 25% foreign owned have to do this form, they want all the US LLCs that's wholly owned by a non-US person to do this form. Because their feeling is that there is foreign corporations that play around with those rules, because an LLC for US purposes, when it's wholly owned, it's not taxed as a corporation, but it's taxed as a flow-through. So the IRS saw that as a sort of reporting sort of loophole, so they want to fix that. The next form is also very common, and the short version of this form is called FBAR. And what this form is that, you know, if you are a US person and you have a non-US account, and the balance of all your non-US accounts together is more than $10,000 US at any point during the calendar year, you have to file this. Penalty for not filing this is $10,000 per violation, and that has interpreted by the IRS to be per account. So if you have 3 accounts that added together is $20,000, but you don't file, the penalty could be $30,000. And the scope of this reporting is fairly broad. It covers bank accounts, mutual funds, and stuff like that you would have in a TD Waterhouse account. And we get a lot of questions as to, you know, my assets are in RSP, they're in tax-free savings account, they're exempt, right? No, because the IRS doesn't recognize that. That's only a tax-free status for Canadian purposes. So what is reported here is pretty standard. They want to know your account number, where it's at, what's the maximum balance of that account during the year. And one thing to watch out for is a lot of the lawyers who are US persons who can sign on the trust accounts, they actually are caught by this as well. Because it's whenever a US person that has authority over a financial account that's non-US. The next form is important because, we have quite a number of clients that says, all this US reporting is too much. I just want to liquidate my US sub and I want to do my stuff in the US through my Canadian company. That's fine. But on the liquidation, what the IRS called an outbound liquidation, they want you to fill out this form that basically tells them what you have done. And the penalty of not filing this form is actually pretty severe. It's 10% of the fair market value of the assets being transferred offshore up to $100,000. Okay? That's not on the gain, that's on the fair market value. And you would file this form whenever a US person transfers assets offshore on an otherwise tax-free transaction, such as a liquidation. And the reason that they want to know about this is, unlike a normal corp-to-corp liquidation that's normally tax-free, when you transfer assets offshore, the general rule is that it's not tax-free. So that's why the IRS wants to know the basis of the assets transferred, the fair market value of the assets transferred, and the gain on the transfer. So now, if you have liquidated your US sub, and you have your Canadian company conducting all your transactions in the US, you're clear, right? Because you no longer have a US sub. There is no more reporting, right? Not quite. The reason for that is there's a treaty disclosure that the IRS wants you to do if you have transaction that's in the US, but you're not being subject to US tax. And the penalty for not filing this form, there's 2 layers of penalty. So 10 grand for corps, 1,000 for non-corps. And you need to file this form whenever you have basically US source income, but you're not subject to US tax. For example, if you can rely on under the treaty provision that basically says that because I don't have a PE, I don't have an office in the US, I don't have an agent that can conclude contracts on my behalf, therefore I'm not subject to US tax, that's all fine and dandy, but you still need to tell the IRS what you're doing. And they want to know what your US sales are for the year and why you're not subject to US tax. Okay, and you have to provide citation on what treaty article you rely to override the normal rules of being subject to US tax. The next one is not a very common form, but it's a very, very convoluted reporting form that you have to do whenever you have a US person that has an interest in a non-US corporation. And the threshold for reporting starts at 10%. So whenever you meet that 10% ownership threshold, this form kicks in. But the most common sort of case that would cause a person to file this form is when what we have known as a CFC, a controlled foreign corporation, which is a foreign corporation that's controlled by a US person or a US corporation. So what needs to be reported really depends on the category of filer you are, okay? But on the assumption that we're dealing with a CFC, this is almost like a mini tax return, in that you have to provide full balance sheet, P&L info. You have to disclose all the transactions between the controlled foreign corporation and the US person / parent. And also you have to provide a calculation of the earnings and profits of the CFC. as well as if there's any subpart F income or 956 inclusion. And the reason for all that is because under the US tax rules, a US shareholder is taxed on the CFC's income not when it's paid, but when it's earned, to the extent that you're dealing with either subpart F or when there's a loan from the CFC to the US parent. And just a word of caution on EMP, we have a lot of clients that says, well, EMP calculation, so that's like my taxable income. That's like my GAAP income, right? No, I mean, EMP is sort of a very unique US tax concept in that it's meant to calculate what is your cash profit. So it's not your taxable income, it's not your T2, because we're dealing with a foreign corporation, so let's say it's a Canadian corporation. So it's not your T2 income, and it's not a US taxable income, and it's not a financial statement income. It's a separate calculation that starts with the US taxable income of the CFC on a US tax basis. And there are many adjustments in getting from a taxable income to the EMP number, which I won't go through. So like I said before, there's two types of income that the IRS wants to tax currently when it's earned by a CFC. And the first category is the so-called subpart F income. And that has a very broad scope, and it basically includes virtually all types of passive income, dividend, interest, rent, all that. And that type of income is not taxed when paid, it's when that will be subject to US tax when it's earned. And also, if the CFC were to make a loan up to the US parent, that is treated as income as well. Because the IRS's view is that, well, you choose not to pay it out, but you sort of want to disguise that income as a loan upstream. The next form, I think more and more people are becoming aware just because of more and more publicity out there. And this form is a little bit deceiving in that, unlike all the other forms where there's a specified penalty for non-filing, this one, there's no stated penalty. So then people will think, well, you know what? There's no penalty, so no harm, no foul, right? Not really, because if you don't file this form, you're gonna end up being taxed at the highest tax rate plus a penalty interest, because you're dealing with a PFIC. So even though there's not a specified penalty for not filing this form, it's to your advantage to file it. So what is a PFIC? A PFIC is any non-US corporation that has at least 3/4 of its income from passive sources, or at least half of its assets as passive assets. And this is an OR test, so you only need to meet one of them to be a PFIC. And the IRS during the years have put out a lot of guidance on this topic just because it's very sort of vague and artsy-fartsy. But one thing to keep in mind is that when you're dealing with cash, cash is always passive for the purpose of the PFIC test. In other words, you can't argue that, I need the cash to run my business, so cash is not passive. That won't work because there's been rulings that the IRS has said without doubt that cash is always passive. So some common examples of what a PFIC would be is a lot of the junior mining companies are PFICs because they haven't started production yet. They have a lot of cash. They earn some interest, so they're PFICs. All the Canadian mutual funds are PFICs. That's thanks to a IRS bulletin that came out that basically says, because of the fact that Canadian mutual funds are quote-unquote trusts and they earn passive income, even though they're not corporations, we're gonna deem them to be PFICs. So all Canadian mutual funds are PFICs. So what is reported on this form, like I said, the main purpose of filing this form is to make one of the two things that will get you out of the draconian highest tax rate plus penalty provision. And one of the options that you have is make the QEF election. That's called a qualified electing fund. And basically, you make that election on this form so that you treat the PFIC as if the PFIC were a partnership. And you get taxed on a flow-through basis versus a court basis. But in order to make this election, the PFIC would have to provide to you, the shareholder, an annual PFIC statement that says, what is your pro rata share of earnings and what is your pro rata share of capital gain? And a lot of the bigger mutual fund houses like Manulife and so forth, they have been kicking out those forms. So that's not a problem. But for some of the smaller funds, they don't do it, so you don't have this option. Your other option is to make a mark-to-market election. That basically pegs the price of the PFIC on the year-end basis, and you get taxed that way. So if there has been an increase in the price of the fund, then you take that amount as your income for that year. But you lose the capital gain treatment. This next form is the cousin and the evil twin of the FBAR form. But it has a larger bite in terms of penalty. So the penalty for this form is, it starts at $10,000, but if you receive correspondence from the IRS and you dilly-dally, that penalty goes up to 50 grand. And this form has a wide range of filing thresholds depending on your filing status and where you live. So for example, if that US person lives in Canada and is filing his return as a joint return, then there is no requirement to file this form unless at the end of the year the total assets is at least $400,000 US, or anytime during the year the asset is $600,000 US. So you compare that to people who live in the US, basically it's a quarter. Okay, so the IRS threshold varies depending on where you live. So like I said, this is basically the evil twin of the FBAR, except that it has a broader scope, okay? And the other thing that this form has that the FBAR doesn't is this form actually tries to match the income from the assets generated to make sure that those income are reported. The FBAR only lists all your bank accounts and the asset value, whereas this one, they actually try to tie in your assets to the income and make sure that that income is reported on the US tax return. So it's a pretty nifty form. So the last one, basically, we have clients that goes, you know what, I'm fed up with all this. I just want out of the US, okay? Like I want to renounce my citizenship. I want to get out. Good, fine. Just make sure that you do this form. So what this form is that, you know, when you try to renounce your status, you have to go down to the consulate and you do your stuff there. You take an oath, okay? But that only gets you out from the citizenship perspective. It doesn't get you out from a tax perspective. From a US tax perspective, you're only out of the US after you file this form. Again, the penalty for not filing this form is $10,000. So the new version of this form, the current year version, hasn't been put out by the IRS yet because I guess the year is not out. So we're only dealing with the 2015 version, okay? And on this form, you have to provide the IRS with your comprehensive financial information such as a balance sheet, P&L, what you own, what you made, and if you are any one of those three categories of filers, that either you had a high US taxes payable for the last 5 years, or you are a high net worth person that is defined as $2 million US. So in Vancouver, that's not really ultra high. Or you haven't been fully tax compliant for the past 5 years, then there's a departure tax. Okay? That departure tax is calculated on the deemed sale of your worldwide assets, not just your US assets. Everything you own is deemed to have been sold at fair market value. Then you compare that, the proceed on those sale to your US tax basis, and your gain then falls out that way. But the IRS does give you this floor of $690,000, okay? So if on this calculation that you do, you have a total gain of say $800,000 US, you'll be only subject to tax on the 110 because of that floor. So just be careful out there, because like I said, we have many clients that thought that they're out because they renounced at the consulate. But you're not out until you do this form. So that basically is the IRS penalty landscape in a nutshell.